everyone. Welcome to a seminar, Financial Management for Small Businesses, presented by Small Business Council with your Bay Area Chamber of Commerce. Just a moment of background of our Small Business Council. It was formed in early 2012 at the direction of your Chamber Board of Directors. And the events that we put on so far have been a networking event. We've had a human resources seminar. We've had a small business advocacy seminar. Upcoming are other seminars including marketing and social networking and taxes later this year. Before we get started in introducing our guest speakers this morning, I think we would like to take a moment, just go around the room so we can know each other better. Just a brief moment, introduce your name, your company, and your position with the company. So again, we can know each other better and our presenters know who we're presenting to. Let's start with you.
Renee Dyer, Galaxy Media, and I do accounting and payroll.
Tammy Widener, DMM and Accounting Services, and my main focus is on offering daily money management services to the elderly.
Jeff Rivard Electric, owner, small company.
Lindsay Rivard, and help him keep them organized.
I am your most humble servant, Michael Seward.
Okay. Jim Gall, owner of Right at Home. We help keep loved ones safe and dependent in their home by providing non-medical services.
Hi, Becky Lauer. I'm Rebecca Lauer Consulting for Government Contract Management.
My name's Lee Newton. I'm with Newton Eye Care Center, and I'm the chairperson of the Small Business Council of the Chamber of Commerce. So, when we talk about financial management for small businesses, in my opinion, it's one of the very most important topics there is to discuss, right up there with customer service. It can be said that if you're not good managing the dollar, you won't have too many dollars to manage. And to that end, we have two expert presenters this morning, a CPA and an attorney, to present to us and to answer and field questions that might arise during the presentation. Excuse me. Both presenters this morning are leaders in our community. Both presenters are leaders in their respective professions. First, I'd like to introduce Mr. Michael Hanisko. He's a CPA for Weinlander Fitzhugh, where he joined the firm in 1984. He's a graduate of CMU with a Bachelor of Science in Business Administration with an accounting major. He currently holds the position Director of Tax within his firm, also earned the professional designation of Certified Specialist in Estate Planning. The majority of his work is in the area of financial statement services, business planning, individual, estate, and tax planning, and tax return preparation for all types of entities. Mr. Hanisko is a board member and treasurer for the Bay Area Chamber of Commerce and treasurer for the Bay Area Community Foundation. Please help me welcome Mr. Hanisko.
The two handouts that Jody passed out this morning are the two items I'll go over today. And when they were framing out the agenda and topics that Keith and I were going to talk about, they had asked maybe I cover some things on QuickBooks. So I had another presentation that we had done for a chamber over in the Clare area. So that one we had a PowerPoint presentation, and I'll go over that one first. So that one has the slides on it. And then the second handout that I have, which I'll go over second in the presentation, is just some miscellaneous tax topics, more directed toward the state of Michigan. So on the QuickBooks handout, again, when we were originally planning, and everybody's got diverse backgrounds, experiences, and knowledge, this is rather basic. The presentation that we made over in Clare was to sort of like a beginning class for business owners. And so what I did here is I got a number of questions and I guess comments and tips regarding QuickBooks at the back end of the presentation. And that's really where I'll concentrate the most of the time and discussion. There's only a few of you here, so Tammy had worked for our firm for a while, and actually I could probably have her come up and do the QuickBooks presentation. When she was with our firm, she had gotten what they call a QuickBooks Pro designation, I think is what it was referred to. And so the product that I was highlighting here was the QuickBooks Pro 2013 product. So I'm just curious, do any of you use QuickBooks? You do, 3, Tammy's familiar with it. You're not using it? And
It
so,
will be, but not.
okay. And so the first couple of comments might be relevant in your case, and this was talking again about, when we started out, we were talking to a class that had gone through sort of the old school manual preparation, which was very cumbersome. So we were talking about the difference between a manual and a computerized system. And ultimately, no matter what accounting system you're using, manual or any variation of a computerized system, it's essential that the business owner keep good records so that they can manage their business. As I turn the page, the top slide on page 2, the two biggest advantages then of a computerized system, of course, would be speed and accuracy. The accuracy I put with an asterisk, and with any technology, the accuracy is only as good as the data that is put into the system. And so that's where we're going to talk about some of the comments and tips at the back end. A manual accounting system obviously is done by hand. And if you can imagine hundreds of transactions recording every check. In the old days where they had ledgers having to record the same transaction in multiple ledgers, just very cumbersome. And there's a great need to verify the data in a number of ways. And so a computerized system would sort of address some of those typical disadvantages of a manual system. On page 3, transactions performed in a computerized accounting system are basically completed with one entry. Those of you who use QuickBooks know that it's mostly really a glorified checkbook with behind the scenes there's all kinds of pockets of ledgers that will capture the data. So if someone understands how to write a check, they're going to be able to use QuickBooks with a little bit more detail and knowledge behind it. With one transaction, the entries are posted in their various ledgers. That's what I've indicated at the bottom. And it is referred to as a double entry system, so that as you record in one area, it's recording the other side of the transaction in the various ledgers that it belongs in. When a check or journal entry is generated, it's automatically posted to the general ledger. If an invoice is issued, it's automatically captured in the receivable area, sales area, as well as the general ledger. Turning to page 4, the other advantage in QuickBooks is really at the blink of an eye, you can get various reports that will give you real-time, up-to-date information with the data that's been entered into QuickBooks at that time. So you have instant access to these various reports. Some of the more common reports that business owners would use would be the profit and loss statement, like an income statement, a balance sheet. The general ledger is more detail behind all the entries, both in the balance sheet and the profit and loss. If the system is using the payroll module, again, if anybody who maybe remembers the old days when payroll ledgers were kept manually, they're extremely tedious. And within QuickBooks, again, that information is just captured instantaneously, so the payroll registers are very good. Customer balance reports on the sales side, and then vendor balance reports on your payable side. It's important for business owners to be active in their business and know how things are going day to day. So this type of a system keeps it up, as long as the data is up to date, gives the business owner that kind of information. Customer balance reports will show what customers have not paid, so you can watch your receivables. And then cash flow depends on payments from your customers, so that again gives you an idea of when expected payments or when payments are expected to come in, so that you can gauge when you can be paying your vendors. And the vendor balance reports would also show if someone's scheduling when they want to pay bills. You can have that targeted so that you might run reports periodically during the month, so that you'll know which bills need to be paid, so that they're paid on time. Just a little bit about the cost of a QuickBooks system. If you have a single user system, this is on page 5, software costs about $250. Multiple user software starts at just under $400, and they also have some online QuickBooks versions that start out at around $26.95 a month. One thing that's important to note is that Sometimes a small business might get started in QuickBooks and they'll maybe add payroll later on if they're a real small business and they haven't had any employees yet. The payroll module is technically a separate module, and that can always be added on later at an additional cost. Down at the bottom of the page, I just think it's important to know because sometimes we'll get involved after the fact. And so here I just indicate that someone thinks that they've got QuickBooks and they don't think that they need an accountant anymore, and I would tell you that that's false. There's probably a lot of assistance that an outside party could provide in making sure the QuickBooks is set up properly and then analyzing the data, maybe doing tax returns at the end of the year. QuickBooks is an accounting system. Yes, it's very easy to use, but you should have assistance in setting it up and using it properly. On page 6, QuickBooks will be used to post your daily activity. This information is necessary to prepare your tax return at the end of the year. You might need financial statements that you can provide to the bank or other creditors. And again, you need it to track employee wage and benefit information and possibly reports for workers' compensation and to do your W-2s at the end of the year. So this type of assistance system can provide all of that. The next couple of slides, again, I just brainstormed on things that we see around the office that seem to be potential problem areas, areas that we provide a lot of help to clients, and maybe some tips and ideas. And in fact, I've got a couple of small businesses that are just getting started, and we meet with them early on, and they're getting the QuickBooks set up to make sure that the chart of accounts is set up properly. And there's some initial setup things that seem very intuitive, maybe to our people in the office because we're looking at it and dealing with it every day. But someone going through it really for the first time, having no other experience, again, it sometimes is good just to have somebody to bounce questions off of. So making sure that things are set up properly from the very beginning is critical. A lot of times, again, as I said, we'll get involved at the back end, and then there's a lot of cleanup and fixing that has to go on in the QuickBooks system to get it working properly. There are security settings within QuickBooks if you want to only allow certain rights if you've got multiple users. And let's say you had somebody that you didn't want them to have access to the payroll module, you can set up security settings so that people can only have access to certain areas within QuickBooks. Another critical area is determining, again, this might be a conversation with you and your accountant, would be whether you're going to be on a cash or an accrual basis method of accounting. And that's critical to know right up front so that helps you understand the types of reports that you'll be using, whether they're cash or accrual later on. Cash is basically that. It's like looking at your checkbook, and whatever is deposited is recognized and whatever checks are written is recognized, whereas the accrual basis will recognize revenue as those invoices are issued to your customers, even though they may not pay you for weeks or months later. And same thing on your liabilities. You might incur a liability to a vendor today and not pay for it until weeks or months down the road, but those either revenue or expense items are recognized immediately as soon as you're aware of them and you've entered them in QuickBooks under the accrual basis method of accounting. The other area that we see a lot of cleanup that might be needed would be just setting up the basic chart of accounts. QuickBooks has, again, a basic chart of accounts depending on what kind of industry you might be in, but there's always a need to add new chart of accounts. And what's interesting is you'll see accounts that are added in the typical classification would be like a revenue or an expense account, or if it goes on the balance sheet, it's an asset or a liability account. And so just knowing those basic areas where the account belongs on the chart of accounts and what its description is, it's really important so that those reports that we talked about earlier on come out properly. QuickBooks is very date sensitive. The other thing that we'll see for clients that we only see their QuickBooks backups periodically is we'll see that data changed since the last time we saw the QuickBooks. A lot of times maybe they're going back and changing the dates on checks or changing the dates on invoices. Well, it will go back in the system and change the data in an earlier time. And there is a way that you can lock down the system. And you can do that either monthly, quarterly, or at a minimum it should be locked down annually. And so that's another very important point, so that it sort of closes the book, so that if by accident someone was putting in a check, and here we are in 2013, if they by accident put a 2012 date on a check, it won't go back and post it into 2012. There is an audit trail report, and that's really good for a business owner who's not actively using the QuickBooks system, so that they can go back and maybe if they've got a bookkeeper or other people involved, they can sort of do an assessment of the transactions that have been entered. So it's referred to as sort of an audit trail. On page 7, again, the accounts receivable and accounts payable detail reports. A lot of times we see they're not reviewed for accuracy. Maybe payments aren't posted properly and are not clearing out invoices. So, again, merely entering the data is not, doesn't mean you're done. You have to go back to the reports and make sure that things are posted properly. Another great tool within QuickBooks is this pay liabilities feature. And for those, it's most common, I guess, for those QuickBooks systems that have the payroll module. There's all kinds of liabilities associated with payroll. It could be to the federal government for federal withholding, your Social Security, to the state of Michigan for unemployment, again, federal unemployment, state withholding. So there's all these different liabilities that are created as a paycheck is issued, and this pay liability area sort of captures all those and keeps track of when the due dates are and what the balances are. And so it's a great feature. But again, it has to be managed, because one classic example would be you're starting the year and you've got a rate in your payroll module for the Michigan unemployment. And then maybe later on you find out that the rate changed. So you end up paying maybe either a larger or smaller amount than what the pay liability report says because of a rate change. Well, then you've got to go into the system and change that liability so that the payment will clear the liability out. So again, QuickBooks does a great job early on. But if you're not knowledgeable of how to make some of the changes midstream, then the reports get sort of messed up later. Again, the fourth bullet point on that first box there says you can also track and pay sales tax within QuickBooks. If you have reports that you really like and you like to see them just on the fly, you can memorize certain reports so that they're easy to get to. Down at the bottom, then I just put some other ideas that people fail to capitalize on. There's a help screen within QuickBooks. I find it extremely helpful for areas that I might be unfamiliar with, so I wouldn't hesitate to tell people to use that help screen. There's also, like there is in any kind of an internet search, where you can have a find feature. So within QuickBooks, if you have a topic and you're trying to figure out, you don't know where to find the information, even in the help screen, you can just do a search for it. Third, make sure that you're doing backups regularly. And interesting point is you'll talk to somebody and say, yeah, I do backups. And they're doing it right to the hard drive on the computer that they're using. And they don't even know where it's going, because it might have a default. And again, you have to know where to look in the settings to know where the default for the backup is. But we've talked to clients before and they'll say, yeah, I'm doing a backup, but I have no idea where it's going. So I guess the key would be know where the backup is going and possibly do it to a separate flash drive or a hard drive off the computer that you're using as your main QuickBooks system. And then periodically upload your QuickBooks file to your accountant so that they can review it and make sure that you're on task. And then lastly, on the back page, the other thing that we have found working with QuickBooks within our office for years is that sometimes clients don't update their QuickBooks, which QuickBooks provides an update annually. And so you might have I have clients that might come in and they'll give you a backup and they'll say, I'm using QuickBooks 2009. Well, the Intuit, who makes QuickBooks, will only support a system for so long. And so if the system happens to crash or something like that, there conceivably could be a situation where you lose data. So we really encourage our clients to just, it's not complicated to do the update. You can do it online. To try to stay as current. If you're still using 2012, you're probably still rather current, but I wouldn't get more than a year or two behind before I would suggest that it be updated. And then Intuit has a really good website where they have webinars that you can participate in. They have trial use of the product, if you haven't used it before. So those are some other ideas. So that's QuickBooks 101. Again, Keith and I were talking earlier, and we had asked us if you have any questions, feel free to ask them as we're going through it. We'll take questions when we're done, certainly, but if there's something that pops up as I'm going through it, feel free to ask.
Mike, you talked about the dual entry system, which is kind of a basic thing in accounting, and I wonder if maybe some of our folks here aren't aware of that, and maybe could you explain what a dual entry system is and why accounting really needs that?
Well, I mean, as a basic tool, we always heard when you were learning accounting, everything has to balance, and we always talked in terms of debits and credits. So if you're in a checkbook, that's entering one side of the transaction, and then there's a second side of the transaction. Okay, now I've entered in my cash, so where else does it go? Is it for utility expense? Then it also needs to be entered in the ledger for utility expense. So there's the second side of the transaction. So again, there's always two sides to every transaction. If you only get one side recorded, then you're out of balance. So that's the purpose of the dual entry. Rather basic, but under a manual system, you can see how it'd be very easy to get out of balance.
Most of us just write the check in our checkbook, so we're used to the one side of the transaction.
Right.
And I think if you haven't ever had an accounting class, you maybe don't understand why accountants need two sides.
Yeah. There are still people out there using manual systems, and literally you'll have different binder with your checkbook, your general ledger, your sales journal, your payroll journals, and then they'll have to be brought together in that general ledger. It's just extremely cumbersome, and QuickBooks just does it like that.
I am one of those, almost ashamed to say, 2009 users.
Uh-oh.
Just because it's,
yeah,
they tell me every year,
yeah,
we want you to update, want you to update, and I'm like, yeah, you want my money, it
Yeah.
works just fine. In contemplating updating to a more recent version, maybe 13 or what have you, and looking at the internet-based version of it,
yeah.
I can see potentially that some of the benefits might be more secure data backup, because they're going to back it up better than
Yeah.
I probably can, not a
Yep.
computer person myself. What about, are there any disadvantages? What about access to data? You're talking about payroll data, sensitive company information. Is that pretty secure?
As far as we know, in trade publications and just others using it, knowledge of Intuit, they're an extremely large company. I think security, there's probably more information on their website if we wanted to look into it more, but I think that their use of more like a cloud-based storage and access system. Access is easy from multiple locations, home, office, possibly, and then you don't have to bring your backup or the computer literally home with you to use the product. So ease of use is certainly a great advantage, and I'm not aware of any security issues that anybody's had. Good question. The other handout, then I'll go over that. And just brainstorming again. When we were talking about the agenda, I thought some of the areas that we see potential problems would be with some issues going on in Michigan. So I thought I'd just highlight some of those. We know about a lot of the other taxes, your income taxes, your Social Security, unemployment taxes, payroll-related kinds of things. So I thought I would pick on the state of Michigan a little bit. And one of the reasons it came to mind is that the state has sort of been on, they're probably on about a 4 or 5 year cycle right now, where they've really been out trying to audit as many businesses as they can. And usually those audits would be either sales tax driven or what they refer to as use tax driven. And we'll talk about that in a minute, because for a manufacturing firm that is hardcore traditional manufacturing firm, they may not be charging sales tax to their customer because they don't have to, but they may have use tax issues, and we'll talk about that in the middle of the page. And so the state will come in to do audits. And so the third thing I was going to talk about at the bottom of the page is this unclaimed property reporting, because that's sort of been a hot area for the state of Michigan. I think that unfortunately I don't like to see when the government would target as a potential revenue raiser trying to catch law-abiding citizens where they're just not knowledgeable of something, that there's severe penalties if you're not filing this unclaimed property. And so unclaimed property reporting, they came out with a system to give everybody a chance to sort of come clean, identify whether or not they were subject to the reporting requirement or not. And so if you merely didn't tell the state that you weren't subject to it, the theory was in the state's eyes that it opened you up to a longer audit period. The typical audit period in the state goes back as 3 to 4 years, and it could expose you to as many as 10 years of possible audit if you didn't follow the rules. But we'll talk about that a little bit more. So the only thing I thought I'd mention on the sales tax area, you know, everybody knows Michigan charges 6% sales tax, and it's typically charged on, if you think about it, if you think of the chain of as a product is sold, if you thought of a car as an example, there's all kinds of parts that go into a car. Sales tax is only charged when the car is actually sold to the final consumer. So all those sale transactions that occur at the various manufacturing levels and assembly levels and until the final product is made, there is no sales tax charged on those various transactions that get to the final product. Once the car is sold to the final consumer, and that's when the sales tax is charged. And that's true with anything. It's ultimately the sale to the final user and consumer that will dictate who charges and collects the sales tax to remit it to the state of Michigan. Now, of course, there's a number of exemptions, and there's an exemption form. So what I found in some cases, I have some clients that have many customers who are not subject to sales tax, but they also have customers who are. And then there's rules that have to be followed for those that are not subject to sales tax. And so under a recent audit, they had come in and they had asked my client to see all the exemption certificates. Fortunately, my client knew the rules. They had a 3-ring binder, and it was A through Z, and they had all their customers who were exempt, and then they had copies of those exemption certificates filed in there. The one thing that the state had cited in that particular instance is that an exemption certificate, which I have a copy of one attached. It's the second page. And there's a front and back to it. It's pretty easy. This is Michigan's version. If you were to do a search, there's all kinds of generic versions out there that you could use in just about any state. And a few years ago, Michigan came up with their own version of the exemption certificate. So as long as you have an exemption certificate where the customer has signed off on it indicating why they're exempt, you would be okay. This exemption certificate is only good for 4 years. That was the thing that came up in the audit that I had gone through with a client. They had an exemption certificate that was like 6 years old. It was still valid, and they just asked the state, said, you know, go back and get an updated exemption certificate so you make sure that it's current. But the classic exemption areas you can see are under Section 3. So someone who says, look, I'm buying my product and I'll be the reseller of that product, meaning that they're going to be the seller to the final consumer again, well then that transaction does not require any sales tax to be charged because that sale is not going to the final consumer yet. So you just need evidence that the sale is being made to a reseller. Sales for agricultural production are not subject to sales tax, and again the other, which is number 5 under Section 3, industrial processing. A lot of clients that I have that are manufacturers, this is the classic exemption reason that they don't charge any sales tax, because all their customers that they might be selling to are industrial processors. And in terms of industrial processing, I'd say it's a manufacturer, but it means that they're taking a tangible product and altering it or changing it in some way, shape, or form. As long as they're making some kind of a change to that in the system, then that is deemed to be industrial processing, and no tax has to be charged on that. So that's a little bit about sales tax. The use tax is, a lot of times people don't think about that, but it really can apply to any business. It doesn't matter what kind of business you are. So when the state comes in to do a use tax audit, the first thing they'll ask for is they'll say, give us a list of your vendors that you buy stuff from outside the state of Michigan. So if you got your favorite office products place and it's located in another state and you're having that stuff shipped into Michigan, they're probably not charging you Michigan sales tax. Because usually a business would only charge Michigan sales tax if they're physically located in the state. So let's say you found this small business located down south somewhere, and you order your product from them and they ship it up here, and that's their only location. So they have no connection to Michigan. They're not required to collect Michigan sales tax. The burden now falls on the buyer or the purchaser of the product. So that's why they call it use tax. The person using the product is now required to pay that same 6% to the state of Michigan. So out-of-state purchases are a classic reason why you may not have paid sales tax at the time you bought it. So that's a little bit of background behind it. A couple of other things that I listed here. Also, if you bought purchases like through a catalog or even internet sales, if you bought an internet purchase here from a company known in Michigan, they may not charge you sales tax because there's still some moratoriums on that, but that doesn't mean that the purchaser is not supposed to then pay the use tax. Or foreign countries, obviously they're not going to be charging Michigan sales tax. The way you paid that use tax into the state of Michigan, for those who have payroll, you send in a little monthly voucher with your payroll withholding for the month. You'll notice that there's about 6 or 7 boxes on that little voucher. You can pay your sales tax, you can pay your state income tax, you can also pay use tax. There's a little box in there for that. So let's say you bought $1,000 worth of product from out of state and you paid no sales tax on it. You would then have to keep your own little track of that, and at the end of the month you would have to send in $60 to the state of Michigan for your use tax. The Michigan unclaimed property, I'll move on to that one then, so I can wrap up here pretty quickly. And again, the rest of the handout, what I did is there's a manual out there. That's the last 3 or 4 pages. I just made a copy of the front cover of the manual and then a couple of pages from inside the manual. Because for most businesses that I run into, the classic example of unclaimed property for a general business owner would be uncashed checks, whether it be payroll checks or checks to a vendor. So in the old days, you used to look at your bank reconciliation and you'd say, wow, you got some checks that haven't been cashed in 2 or 3 years. Let's just void those checks out. Technically, you can't do that. You're supposed to have made every effort to contact that vendor and either make sure they cash the check or replace the check by giving them a new check. And part of the manual here talks about the due diligence on you, the holder of the money, to have documented that you've made every effort to contact the person who's owed the money. So they have all kinds of rules, and they actually have sample letters in the manual for sending out letters and documenting it. If the letter comes back, for example, address unknown, documenting that kind of information. And so a lot of times we see this with employees where there's a lot of situations where somebody hires somebody and it's not a job for them, so they leave after a couple of days. So they've only worked there for a few days, so you never really had a chance to get a connection with that employee, and then you try to contact them at the end of the year to get them their W-2, and it comes back, and so you got an uncashed paycheck maybe still sitting there, and weeks and months will go by, and you can't find the person. Maybe they moved out of state. Well, you can't just void that check. You're supposed to send it to the state of Michigan. And you may have read articles from time to time. You'll find somebody who says that you can go to the state's website. You can say do a search for unclaimed property. You can put your name in there and see if there's anything out there under your name, if anybody's ever done that for you. And there are services where it'll search all states and see if there's a bank account or an uncashed check. So years ago I was doing that, and I thought I'll put in everybody in my family, and I found my dad had an old bank account that his parents had put his name on, and it had about $10,000 in it. He never even knew about it. And my sister, she worked for I think it was Michigan Axle or something like that, and she had left and moved to another state. And then months after she left, they had some kind of a back pay system where they credited people for unused vacation or something like that. And so she had a paycheck still sitting out there, classic example. So you just had to fill out a form and then they send you your money. But anyway, that's a little bit about the unclaimed property. On the back of this agenda, my last comment would be just the fourth area was Michigan corporate income tax. In 2012, was under Governor Snyder, they had done away with what was referred to as the Michigan business tax, the MDT, and they replaced it with what's called the corporate income tax, the letter CIT. And the only thing I wanted to mention here is that the MDT was an extremely complex and burdensome system, and the corporate income tax is much easier. And it's only applicable to C corporations, and I know Keith's going to talk about choice of entity here in a minute. But any business that is a flow-through entity, including sole proprietors, anybody filing a Schedule C, a partnership, an LLC, or an S corporation, those types of entities are not subject to any kind of business income tax here in the state of Michigan any longer, starting in 2012. So that's just very basic about it. If you're a C corporation, you still have to file the tax, but it's still a lot less burdensome in calculating the tax than what the old MBT system was. Literally, under the old MBT, we would have tax returns that were 40 pages of forms and documents and calculations. That same tax return can be done today with 2 pages under the CIT. Is there any other questions I could answer right now? I'm sorry.
Sales tax. Me being an electrical business and I will like bid jobs, do I have to charge sales tax for my work? Or, and also if, like some jobs I'll bet I'll do this job for X amount of dollars, and other jobs it may be I'll do this job at this rate plus whatever the material costs.
Yeah, if you're going to isolate the material cost, that piece of it is like when you go get your car fixed, you'll notice that they separate the labor from the material and they only charge sales tax on the material. I mean, I had an electrician come over once because I had a circuit that was blowing or something, and I guess there were some wires that were crossed. So there was no material. I had to pay the guy for 2 hours of labor or whatever it was. Well, so there was no sales tax on that. So if it's a job that you know is all just labor intensive, and maybe small minor parts that you've built into your labor pricing structure, you don't have to charge sales tax on that.
And I know that I pay sales tax when I buy the material. So really, unless I'm putting in material and I'm upcharging the material, then I'd have to pay a sales tax. But if I'm just doing a job and that's all included in my price, don't worry about sales tax.
That's right.
Okay.
Yep.
All right.
Does he have an exemption, Mike, for when he buys product that he is expecting to resell to his customer, though?
He could do that.
Yeah.
He has to just decide what's going to be easier for his type of clientele and business. You know, certainly if he filled out an exemption certificate and didn't pay any sales tax on anything, now he's got more of the burden of collecting it to the final customer. Whereas if you do pay the sales tax, then you're relieved of some of that responsibility then.
Okay.
And obviously it's built into your price that you're passing along to your customer already.
I've been kind of worried about that for the last while.
Yep. Okay.
Thank you.
Clarification on the unclaimed property. It says there are stiff penalties for not filing. Do you have to file if you have no unclaimed property?
Well, that was the interesting thing is a few years ago when this became a hot topic, there was a form that you could file with the state indicating that you generally don't have anything, or you haven't had anything and you don't currently have anything. That way they wouldn't expect a report. So that form really isn't applicable anymore. It was like a one-time use. So presumably, if you're not filing the form, presumably you don't have any responsibility, and you don't have to file the form if you don't have anything.
Okay. I mean, I remember filling out something once, but I just don't want them knocking on my door.
Yeah.
You know? Okay. Other questions for Mr. Hanisko? Thanks, Mike.
All right.
Our next speaker, Keith Birchler, is an attorney for Birchler, Fitzhugh, Purtell, and Sarow, PLC. He received his undergraduate degree from the University of Michigan in 1975 and joined the law firm in 1978. His primary areas of law practice include creditors' rights, including bankruptcy and litigation, commercial law, business formation, representing landlords, estate planning, probate, and real estate, including condominiums. Mr. Birchler serves on the Board of Directors at the Bay Area Chamber of Commerce. Serves as University of Michigan Club of Bay City, where he's been president and scholarship chairman. He is past president and active volunteer of the Dow Bay Area Family YMCA. He's also active in his church, currently serving as cantor and choir member. He performs regularly with the 60s rock band Paisley Fog. Please help me welcome Mr. Birchler.
Thank you, Lee. In the shameless self-promotion department, I'm going to talk about the Paisley Fog for a moment here. I'm also on the board of directors for the Bay Arts Council, which produces your weekly Wednesday in the Park free concerts. And this year we're doing a special concert prior to the first Wednesday, free Wednesday in the Park. And this is a fundraiser for the Bay Arts Council to help fund the Wednesdays in the Park so that the other 7 concerts we do all summer will be free. So the Paisley Fog will be appearing on the Winona Park stage along with our good friends from Windsor, the British Beat 66, with a little international battle of the bands on June 12th, and I hope you will all be there. It's $10, and that donation to the Bay Arts Council will go to help keep those concerts for the rest of the summer free. I'd like to go back a little bit and talk about your choice of entity when you're getting started in your business. And you've probably all done this already, if nothing else by default, by not actually making a specific choice. But you actually do have a number of choices of the type of entity you want to be when you're operating a business. The first choice there would be a sole proprietor. So if you're an individual and you just start up a business, I'm Joe and I start Joe's Electric, that's a sole proprietorship. And the advantage of it is there's really nothing to do. The only thing you need to do is if you use an assumed name, like Joe's Electric, you should file an assumed name certificate at your local county clerk that costs $10. You can go fill it out right at the clerk's office and pay them your $10. Your tax reporting for that would be on a Schedule C with your 1040. It's a separate schedule that you include and show your income and expenses of your business. The disadvantages of being a sole proprietor is that you get no liability protection for that. With other kinds of entities, you can limit the liability of your business in certain ways. If you're a sole proprietor, anything that you owe to a customer that you haven't paid for, you're personally liable for it. If they sue you, they can get a judgment and collect from your personal assets. So if you think of your business as being separate from your home life and the rest of your life, it's really not separate from a legal liability standpoint if you're a sole proprietor. The next choice I've given you there is a partnership. So if there's 2 or more persons engaged in business together, you may be a partnership. You can be a partnership either at common law without having any particular formal agreement, or you can actually write up an agreement or have an agreement with your partner. It's very simple, it's very cheap, it can be done on a handshake. Back in the musical area, which is something that I like to do for fun, I want to give you an example of probably the most famous handshake partnership that I know of. Anybody here know who Frankie Valli is? I'm going to date myself. Who's Frankie Valli?
That was way before my time.
He's the lead singer of the Four Seasons, which was a 60s vocal band, and he's still active in the music business. Frankie Valli has a handshake partnership with Bob Gaudio. Bob was one of the other members of the Four Seasons, and And he wrote a lot of their songs, and he wrote a lot of the songs that Frankie Valli sang as a solo artist as well. In the early 60s, when they were first getting started, and shortly after the Four Seasons had formed, each of them believed that the other guy was incredibly talented, and they were both a little unsure of their own talent. And as a means of hedging their bets, they made a handshake deal, and they each agreed to give half of their income from their careers to the other guy. Okay, so Frankie Valli said, okay, half of whatever I ever make singing, I'm going to share with you, Bob. And Bob said, half of anything I ever make as a producer, as a songwriter, I'm going to share with you, Frankie. They shook hands on it. They never wrote anything down. To this day, they still operate that partnership. And they file their partnership return every year, and they share their earnings from their businesses. And while they were in business together as the Four Seasons for many years, that really was just the early part of both of their careers. And they went on to have very successful careers apart from one another as well. And they maintained that partnership on a handshake. Many of you heard of Jersey Boys, which was a Broadway musical that was based on their lives and the career of the Four Seasons, and their handshake partnership is actually featured in one of the scenes in Jersey Boys, and it's still in effect today. So it can be very simple. If you've got a buddy and you want to start a construction business and you want to shake hands on it, you can do that. There's probably not too many examples of that would go on for years and years and not have some serious disagreements. Most people like to kind of write it up and write it down, but Frankie Valli and Bob Gaudio say if they had written it down, it probably wouldn't have lasted this long. One of the disadvantages of partnership is, again, there's no limited liability protection. Partners are personally liable for all debts of the business. So if the business incurs a liability, if your partner is driving the partnership truck down the road and he is in an auto accident and hurts someone, you as his partner, even though you weren't driving the vehicle at the time, that's a partnership vehicle, he was on partnership business, both partners are liable because that's an obligation of the business. If you want to limit your liability, there's a couple of choices you can make. You can form a corporation, which is a separate legal entity. It would limit the liability of the business to the assets of the corporation. But I need to make one clarification to that. It doesn't limit your personal liability for something that you do that's personally wrong. Okay, so if I incorporate my business and I'm driving that company vehicle down the road and I'm personally negligent by running the red light, okay, even though my company is incorporated and I'm the president of the company and my vehicle is owned by the company, I'm also personally responsible for things that I personally do that would impose liability. And running that red light is my personal negligence. So both my company and myself are liable for the injuries caused in that car accident. On the other hand, if one of my employees is driving down the road and they do that, they're personally liable and the company is personally liable, but me as the owner, I'm not personally liable for what my employee did when they committed that tort, okay? So you can limit your liability with an incorporation, but you can never limit your liability for your personal negligence. So for instance, the physician who commits malpractice while he's conducting an operation. He may have incorporated his medical practice, but he's personally liable if he does something wrong himself. The disadvantages of the corporate form would be the cost and the record keeping associated. You've got to file articles with the state. It's really not that expensive, about $50. You can file your articles to incorporate your business. You need to adopt bylaws and keep a corporate minute and record book. That's something that not all people are real religious about doing after they start their corporations, and it's important to do to maintain that limited liability protection. If you don't maintain all the corporate formalities when you incorporate your business, it's possible that if someone has a claim against the corporation, they could do what we call piercing the corporate veil and claim that, well, you didn't really maintain proper corporate formalities, you didn't follow the appropriate system for keeping a corporation as a separate entity, and your corporation is really just you. And so we're going to try to pierce the corporate veil and get you personally. Early in my career, I had a collection against a local business that was incorporated that will remain unnamed at the moment. They were playing a little fast and loose with their corporate formalities. They had allowed the corporation to lapse and essentially disbanded the corporation, but they maintained a phone listing for that corporation. And whenever anyone would call the phone listing for the corporation, they would redirect the business opportunity to a different corporation. And I had a client who had a claim against this defunct corporation, and we sued and got a judgment, and we were trying to collect that judgment, and the owner of the company, we brought him in for what we call a debtor discovery, and I may talk about that a little more later. And this business owner claimed, well, that company's out of business. It failed, it's gone, there's nothing to collect from. But I was able to establish through his testimony that he still maintained this phone listing, that if anybody ever called that, the phone was answered by this other corporation that he owned. He also had maintained a bank account for the original corporation, and he was conducting some other completely separate business activities and running those through the bank account of the defunct corporation. And I was successfully able to pierce the veil of that corporation and collect the account for my client. It made my reputation with our former bankruptcy judge, because he'd been trying to collect from the same business for years and had never been very successful. And when I successfully collected from that business, the fellow who was later appointed our bankruptcy judge here in Bay City always gave me props for that, and it really helped cement my reputation with our bankruptcy judge, which helped my clients a lot, because then he respected me. Another type of entity you could file is a limited liability company. These have become very popular, and one of the nice things about a limited liability company is you can limit your liability the way a corporation can, but you can be taxed like a partnership, and some of the documentation is a little simpler for a limited liability company. A corporation can also be taxed like a partnership. Mike mentioned an S corporation, and I don't know, maybe some of you have made an S corporation election. So if you're a corporation and you want to be taxed like a partnership, where all of your earnings flow through to you as the owner of the company, and are just taxed on your personal 1040, you can do that by making an S-corp election. But if you file as a limited liability company, you can also be taxed like a partnership, and your earnings will flow through. If you're an individual, a single member limited liability company, which initially when we first started the limited liability companies, you couldn't be a limited liability company if you were just one person. They subsequently amended the statute to allow for that, and now an individual can file a limited liability company filing and adopt that form. But on your tax return, you're going to report your income on a Schedule C like a sole proprietor would. Disadvantages for a limited liability company, you really should prepare an operating agreement. I've listed that under the disadvantages because it's something you have to do. It's really not a big disadvantage, but it's something that you should do. I do recommend that people have an attorney draft their operating agreement. An operating agreement for a limited liability company would be akin to a partnership agreement if you're partners. It sets the rules of the road for your business. It establishes what the legal relationship between the different members of the company. So if you have 3 members in your limited liability company, like I do for the real estate partnership that I'm in, or 4 members like I do for the law firm that I'm a part of, we have an operating agreement that says what those members of the company, what our relationship is to one another, what duties we owe to one another, how we divide up the income of the company, what happens if one of us should pass away and owning an interest in the company, and so on. There's an annual report you have to file if you're a limited liability company, generally about $25 to the state of Michigan to file that annual report. Are there any questions about type of entity? Has anyone here filed an entity for their business? Is anybody incorporated? Okay. Any limited liability companies? Okay. So you know you have that annual report you've got to file. I would make sure that you've got an operating agreement. If you're a single member, it may not be critical to have an operating agreement, but if you ever go to a bank to borrow money, they're going to ask for your operating agreement. So if you don't have one, you're probably going to have to establish one at that time. Let's talk about collecting your bills a little bit. If your customer fails to pay you, what do? Under the self-help category, the easy things are you don't do business with that customer anymore. You put them on a COD basis. Don't ever try to repossess anything you've sold to a customer. If you've sold your customer product and they don't pay you, you can't just go out and take it back. Okay, the only time you could legally do that is if you had retained a security interest in those goods, and we'll talk about that a little bit later. You do have the opportunity to go to small claims court and file your own suit to collect from your customer without having to hire an attorney. And I can tell you, hiring an attorney to collect a small account is not going to be cost effective for you. Okay, it's just too expensive. It's very difficult for me to get involved for a customer that's owed a few $1,000s, and to be able to go through the legal process to recover for that customer without eating up everything that I recover for the customer in my cost of pursuing that case. The state has recently raised the limit on small claims. It used to be $3,000, it's now $5,000, and there are some scheduled increases in that over time. How do you file a small claims court? There's an affidavit form that is a standard form that you would file, and I meant for it to be included in your materials, and I discovered it was not, but I think Jody made a copy and probably handed them out. So you should have a copy of that affidavit form there. It's what we call a SCAO form. Supreme Court Administrative Office creates those forms, a standard form throughout the state for filing a small claims case. So anywhere you go in the state, you would use that same form. It is available online. You can go to the Michigan, State of Michigan website, courts.mi.gov. And there's actually a publication online there that tells you a little bit about how to go about a small claims case, and has that form in a PDF format that you can actually fill in. You can't save it, but you can fill it in and then print it right at the time you're online using it. You do have to pay a filing fee with the local district court. You would file at your local district court. So here in Bay City, you file at 75th District Court, which is in the court building on Washington Street. If you're suing in Saginaw or in Midland, they have their own district courts there, and you would file there. You generally file where the defendant is located. So if you sell to a customer in Midland, you need to sue that customer at the small claims court in Midland, not in Bay City. If you sold to a customer in Saginaw, likewise. So if you have an electric job and you travel to Saginaw Township to do some work on a customer's home, and that customer doesn't pay you, you are going to sue in the small claims court in Saginaw, not in Bay City. Yes?
What if it's out of state? Say,
if it's out of state, generally you would not be able to sue in Michigan unless that out-of-state customer has what we call minimum contacts with the state of Michigan to enable you to take jurisdiction over them. If you sold to the customer out of state and shipped to them, and they didn't really come to Michigan in any way to do business, then you can't really avail yourself of the Michigan courts. You would have to go after them in the state where they're at. Because the courts can only take jurisdiction over people and property which are within their locale. So a resident of Florida who hasn't ever come to Michigan, if you sued them in Michigan, you might send them the papers and file your case, and they ignore it, and you take a default judgment in Michigan, and then you think, oh great, I've got my judgment, I'm going to go collect from these people. Well, they don't have any assets here. The Michigan courts aren't going to be able to help you do anything. So then you have to take that judgment and go to the other state and sue on that judgment in the other state. And one state is required to give what we call full faith and credit under the Constitution to another state's judgments, okay? But if you took a judgment against a Florida resident who has no contact with the state of Michigan, you took that judgment in Michigan, when you go to Florida, that person can say, wait a minute, Florida doesn't have to give full faith and credit to that Michigan judgment because I'm a resident of Florida only. I've never been to Michigan in my life. They can't take jurisdiction over me. They can't make me go to Michigan and defend that case when I'm a resident of Florida. And so the Florida court will throw out the Michigan judgment in that case because the person didn't have an opportunity to defend. You can't make somebody go there.
Yeah.
Now, go ahead.
Excuse me. Does that work for business to business too?
Yes, but if the business has what we call minimum contacts with Michigan, you may be able to take jurisdiction over them here. So that if there's a Florida business that does come to Michigan and do some business here and sells product here, sends a delivery truck from Florida up to Michigan to deliver product from time to time, that may be what we call sufficient minimum contacts for the Michigan courts to take jurisdiction over that Florida enterprise and say, well, you are taking advantage of the state of Michigan and Michigan customers and Michigan locations to operate your business, and so the courts in Michigan would be able to take jurisdiction in some of those cases. And certainly if that out-of-state business has any property in the state of Michigan, they would be subject to Michigan jurisdiction. So, you know, your Barnes & Noble bookstore, you know, they have a bookstore in Saginaw, all right? They may be incorporated in Delaware and they may have their chief office in California somewhere, but they are subject to being sued in Michigan, and Michigan courts can take jurisdiction because they have physical locations here, they own property here, and they do business with customers here. So getting back to your small claims, your filing fee will depend on the size of your claim, and I've listed those there. You have to serve your defendant with a copy of the affidavit and claim. That can be served either by certified mail with restricted delivery. It has to be delivered to the defendant. They have to sign for it. Or you can serve it personally through a process server. Your local district court will have a list of people who serve papers for them, and they can get those papers to the process servers or give you the list of names so that you can get the papers to the process server. So then you get your defendant served, and you get your day in court, and you appear in front of Judge Kelly or one of the other district judges who's sitting in small claims, or the local district court magistrate who's hearing the small claims cases that day, and they decide, yes, you did the work and you're entitled to the money, and I'm going to give you a judgment for $4,000 for that claim. Great, you won, right? It's all over. Not really. You have to then try to get the money out of the defendant, and you know, if they don't just voluntarily walk down to the bank with you and withdraw the funds and hand the money to you, there's a further process you have to go through. And you know, oftentimes when you're suing someone like this, it may be someone who is financially in trouble or financially irresponsible, and they don't have a lot of money in their bank account. The easy way to collect from them once you have your judgment is to file a garnishment on their bank account and get the money out of their bank account if there's money there. Okay? If there's no money there, the bank's going to send a response to your garnishment saying, you know, no balance. The garnishment process itself is a little separate process you go through after you get your judgment. There's another set of forms like that small claims form that's a garnishment form that you have to fill out and pay a filing fee for that. You have to send it to the person you're filing the garnishment on, both the defendant and the person that owes that defendant money. So if it's a bank, if you know your customer does his banking at Citizens Bank, you send the garnishment to Citizens Bank, and you send a copy to your customer, and then Citizens Bank files a disclosure saying, well, yes, we have some money, or no, we don't. If they do have money, great. If they don't, then you know, you got to try again. If your customer is employed, and you know where they're employed, you can file a garnishment against their employer, and the employer may be required to withhold money from their wages and pay it to you to satisfy your judgment. One nice thing about garnishments in the state of Michigan now that changed during my practice lifetime is that we now have what are called periodic garnishments. They last for a while. And so if you have a wage earner that owes you a judgment, you can file a garnishment against their employer, and it's good for 90 days. So if you're the only garnishment that has been filed against that wage earner, the employer will have to withhold from their wages every paycheck during that 90-day period and send you a check. And it's much easier to collect. When I first started practicing, and really for many years, you had to file a new garnishment for every paycheck. So if somebody got paid weekly or bi-weekly, every time they got paid, you had to file a new garnishment. So that's one development that occurred about 10, 12 years ago that was much more favorable for you trying to collect your accounts. Sometimes your wage earner, even though they're working and making wages, your garnishment may not actually produce anything. If your wage earner is earning minimum wage working at McDonald's and they only work 15 hours a week, there are certain exemptions that federal law puts in place for wage earners, and people that make minimum wage and don't work very much are not going to rise above the exemption amounts, and there's probably not going to be anything you're going to hit on that garnishment. But if you've got a full-time employee, even if they make minimum wage, there's a limit to that exempt amount, and you should hit at least a little bit on each paycheck. You can actually levy against the assets of your customer and have those assets seized and sold. I'm not going to talk about that in any detail because it's quite frankly a difficult, cumbersome process. I wouldn't expect any of you to be very successful in pursuing that individually. Even attorneys have trouble getting through that process, and I've been doing it for years, and there aren't very many of the court officers who are authorized to do those property seizures and the sales that are the process that the statute sets forth for selling that property. There aren't that many of those court officers out there, and it's oftentimes hard to get those court officers to really get out there and do the job for you. So as a practical matter, collecting your small claims account, you're really looking at garnishing somebody's wages or their bank account.
Would that be considered levying? Would that be considered like filing a lien on a property?
Well, filing a lien is a whole separate thing, and there's only limited times when you can do that. Now, you have an electric business, and you may make improvements to real estate. You would have the opportunity in at least some of your cases to file a construction lien for your work. Someone who's selling product out of inventory to retail customers would not have a similar kind of thing. You as someone who makes improvements to real estate do have that opportunity to file a construction lien. And if you're in the kind of business like that where you're making improvements to real estate, you can file a construction lien, but there are strict time limits that you have to follow in doing that. So you want to probably work with your attorney to help set you up with the forms that you'll need, You can do some of the process yourself as far as filling out those forms and getting them served, but you want to make sure that you understand the forms and how to use them to establish your lien.
So you suggest getting with an attorney on that?
I think that would be a good idea to set yourself up, educate yourself on the process, get the appropriate forms, know how it works. You have to make that claim within 90 days after the last work on the project. So the last time you worked on the building, you have to get your lien in within 90 days.
Okay.
So that is actually an excellent avenue for him to collect that most of you don't have. You get that construction lien filed, and then you have 1 year after the filing of the construction lien to foreclose that lien. It's a process you do through court, and you're probably going to need an attorney to do the foreclosure. But it's like your bank foreclosing on your mortgage if you don't pay your mortgage. There's a process where you can actually force the sale of the property if your lien doesn't get paid. And it's a good avenue for people who are in the construction trades to get paid. Now, if you're doing work on a residential home, they really change the process so you can't actually force the sale of a person's residence to satisfy a construction lien anymore. But there is a fund at the state of Michigan that if you pursue your construction lien against a residential property, you may be able to make a claim against the fund at the state of Michigan. And all contractors have to pay into that fund in return for the protection that is available to residential homeowners. If you're doing a job on a commercial contract, so if you come and do some wiring at my office building on Center Avenue, you can actually have a lien directly on that commercial property and force the sale of the property if I don't pay you for your work.
So in residential, new construction would probably be the best lien to follow because they haven't moved into the house yet, or banks actually have to pay out to
the bank is if it's new construction and there's a bank with a construction mortgage that's doling out the money every so often, they're gonna look to see that any contractor who files a lien is gonna get paid out of the next draw. So you want to follow your lien process for that purpose, really, just to try to make sure that you get paid from those draws. But technically, you really don't have a lien on the property itself in residential construction. You can't force the sale of the home, but the title company and the bank is going to try to make sure you get paid, and there is the construction fund at the state of Michigan that potentially you could recover your lien from that if you didn't get paid otherwise.
Thank you.
If you have a claim that's higher than the small claims limit, then you have to file that in regular district court or circuit court. So if you have a claim over the $5,000 small claims limit, but up to $25,000, that would be filed in the district court. Locally in Bay City, we have 3 district judges, Judge Kelly, Judge Janer, and Judge Kleida. Your case would be assigned randomly to one of those 3 people when you file it, and it would proceed in the court. As a practical matter, you're probably going to need an attorney to pursue a case between $5,000 and $25,000. And if it's over $25,000, you have to file in circuit court. Your attorney in those cases would either work on an hourly or a contingent fee basis. There are attorneys that do what we call commercial collection practices, where they operate on a contingent fee basis, and they try to collect accounts for people. You tend not to get a lot of personal attention from an attorney working on a contingent fee basis, collecting a commercial account like that. But you're only going to have to pay out of pocket for their filing fees and out of pocket costs. They won't charge you if they can't recover. You'll have the same, once you get a judgment in one of those larger cases, you have the same issues with collecting it that you do with your small claims case. So if your customer is just broke, unemployed, broke, a bankruptcy candidate, if they file bankruptcy, Chapter 7 bankruptcy, the vast majority of Chapter 7 bankruptcies are what we call no asset cases. People don't own assets in excess of the exemptions that are allowed under bankruptcy law, and so if your customer files bankruptcy, there's very little prospect that you're going to get paid. But you should be aware that if you ever have a customer that does file bankruptcy, it's important for you to stop all collection efforts when you get that bankruptcy notice, because the bankruptcy law has something called the automatic stay, and the automatic stay is a law that says that if you continue to try to collect from your customer after getting notice of the bankruptcy, you may be held in contempt of court and liable for damages to that person. So don't call them on the phone, don't send them another invoice, follow the bankruptcy process. You need to file your claim in the bankruptcy court. Or if you have a lien on their property, and that lien may be good in the bankruptcy process, and so you need to go through the appropriate procedures to try to recover your lien, but following the bankruptcy process. The stay still applies. You can't start foreclosure on your construction lien without first getting the permission of the bankruptcy court. That's called a lift of the stay. So be aware of that if you have a customer that files bankruptcy. One of the disadvantages of suing your customer is that it may expose you to a countersuit. Okay? Anytime you sue someone, if they have a claim against you, they can file what they call a counterclaim. And then that puts you on the defensive, having to defend that claim. So if you did some work for a customer and your work was shoddy and it caused damage to some aspect of their building, then they may be able to countersue you and claim from you the damages that occurred at their building as a result of your shoddy work. So anytime you sue a customer, if they have a claim against you, they can assert that claim in a filing back against you with their answer, and they don't even have to file a filing fee for that. It's just a right that they get to bring their claim before the same court and have the same court hear their claims back against you. I'd like to talk about reclamation, which is a somewhat rare but a very valuable right you would have if you sell. Does anyone here sell actual products where you sell out of inventory and deliver a product to a customer? Okay, so it probably doesn't apply to anybody here. If anybody, you know anybody that does that, you do have, if your customer files bankruptcy, you have under the UCC what's called a reclamation right. If you've delivered product on credit to your customer and within 10 days after you deliver that product they file a bankruptcy, you have a right to reclaim the product. So you remember earlier I told you don't go to your customer and try to take the stuff back when they don't pay you. There's one occasion you can do that without a security interest, and that's if they file bankruptcy within 10 days after you delivered the product to them. You have a reclamation right, but don't go out and just grab it. You need to file the reclamation claim, and you have to act very quickly to do that. So if you know have any friends or relatives that are in that kind of business, if they're aware of their reclamation rights and they get to their attorney quickly after they get that bankruptcy notice, they may actually be able to recover property. And that's an important right oftentimes when a business is selling to another business and the buying business goes bankrupt. The selling business might have delivered $10,000 of product to them just a few days before. And if that happens, they may be able to reclaim that product. So, you know, if Lee just ordered a big order of contact lenses from Bosch & Lomb, and the truck comes and delivers those contact lenses, and then Lee files his bankruptcy petition 2 days later, Bosch & Lomb can file a reclamation petition and try to take those contact lenses back that they delivered within 10 days of the bankruptcy filing. In the planning ahead department, you can sell on secured credit. Most of you, if you are service providers, that's probably not something available to you. But if you actually sell a product and you have repeated sales to the same customers, it may be useful for you to establish a secured credit program. I have a customer out in the Thumb that sells milking equipment for dairy farmers, and they also service that milking equipment and install it. But a big part of their business is the actual machinery that they install at the farm. He was having trouble with farmers that wouldn't pay him for the equipment after he had installed it at the milking parlor. And he was carrying them on an open account, just giving open credit. He'd go out and do business with his customer, install machinery, service that machinery, and expect them to just pay him on 30 days open credit like many businesses give to one another. And I set him up with a secured account where he could have his customer actually give him a security interest in the machinery that he sells and installs, so that if the customer doesn't pay it, he does then have a right to go out and repossess the machinery, take it back, and remove it from the farm if he doesn't get paid for it. But that's a process you'd have to file by taking a security interest and filing that security interest with the state of Michigan. I don't have on my outline, but it occurred to me this morning that maybe some of you might want to talk about bank financing for your business. I do represent a number of commercial banks that do business with small business people, so I could answer questions about your bank financing if you have any of those. Typical bank financing for small businesses is going to be accounts receivable and inventory financing. If you either sell goods or services on credit and you have a lot of customers that owe you accounts and pay you on a regular basis, the bank may give you a line of credit secured by your accounts receivable. In those cases, the bank actually has a right, if you don't pay them, the bank can collect from your customers directly. That's what secured accounts receivable financing would be. That's one kind of financing that small businesses sometimes can get from their bank. The other typical financing would be term loans from the bank that are secured by your assets. So if you have a lot of trucks in your business, you may get a term loan from the bank secured by your trucks or your vehicles, just like when you buy a new car and you have a security interest to GMAC, or what do they call themselves now? Ally, I guess. GMAC doesn't exist anymore. So banks will do that kind of financing on a term loan basis, or make a loan secured by your real estate if your business has bricks and mortar. There aren't too many banks that will give unsecured credit to small business people, unless you've been in business for a really long time and they know you real well and you're a good credit risk. Then you may be able to get an unsecured line of credit from your local bank. But typically for small businesses, banks are going to want some collateral when they make a loan to you. And as a small business, you may need a line of credit or a loan to provide you with working capital so that you've got the money to go out and buy the materials that you need in order to complete that job for your customer, and that customer is going to pay you when the job is finished. So many small businesses do need to get loans from their bank to provide that working capital.
It seemed to me a few years ago, maybe 2010, 2011, that banks really tightened down quite a bit. They weren't making too many loans to small businesses.
That's very true.
Have you sensed that has changed a little bit back in the other direction?
Yes, I would say it definitely has. I think all of the banks have loosened up a little bit. Their balance sheets are in better shape. They are more interested and more willing to make loans to small businesses now than they were 2-3 years ago. Many of them were actively collecting from their small business customers for a period of time. And some of that was driven by the regulatory folks. The people that regulate the banks were looking at the banks and saying, you're not in good financial shape, bank. You have too many liabilities and not enough assets. You've got a lot of loans on your books that look shaky, look like you're going to have a hard time collecting. And the regulatory authorities, the Fed and so on, required the banks to really go out and try to collect from some of their existing customers. And that was very difficult on many small businesses who had good relationships with their banks in the past and suddenly had their lender calling them, and instead of offering to give them more money was saying, you've got that $100,000 line of credit, you got to take it down to 50. You got to pay it down, or we're going to call your loan and we're going to collect it all. So that was very much driven by the problems in the economy and the regulatory environment that the banks were under. But most of the banks are loaning much better right now. And for a small business, small community banks are often a good choice. And some of the bigger banks have specific programs for small businesses. So it's always good to get to know your local banker and get to know them personally. Develop relationships with your banker. That's something you can do through the chamber. Most of the banks have members and employees are pretty active in the chamber. And so that may be helpful to you, a connection you can make through the chamber with your local banker.
Other questions from Mr. Birchler at this point? Thanks a lot. What we'd like to do now, I feel for the balance of the time we have together, is bring both of our presenters up together and have them both answer questions as they come. And I know I've got a couple in my mind that I'd like both of their angles on, and if nobody else has any, I'll go ahead and start. I listened with interest in the discussion of different entity types, okay? And I want to know, personally, is there an entity, I know there's no one best fit for all businesses, but taxes being probably one of the biggest expenses small businesses have to deal with, what are some of the ways that an entity could protect a small business from liability, yet how can we minimize what we pay in taxes?
Probably the pass-through entity is the most important way of doing that. With a corporation, if you're what we call a C corporation, Mike mentioned the term C corporation. That's a traditional corporation that is taxed at the corporate level. And Mike, you want to talk to that and what that means when you're taxed at the corporate level?
Yeah, so in a regular C corporation, the entity is a separate legal and distinct entity and has its own tax environment. In addition, the owners typically, if they're drawing a salary or a wage, then they're paying tax on whatever income they can pull out of the company. So at the end of the year, for example, if there's a profit left in the company, the corporation will have to pay tax on that. And if the corporation...
And that's at a different rate than individuals. There are corporate
Right.
corporate rates for those taxes, right?
That's right. So, and it's completely different tiered rate structure. It's 15% on the first 50,000, and it graduates up, similar to what the individual, but the brackets are slightly different. So if there was a profit left over after the tax was paid at the corporate level, and the owner said, "Hey, I'd like to take that additional money out as a return on my investment," and say they wanted to take a dividend out of the company, then the owner's going to have to pay tax on that dividend again, just like if you get dividends from any large company you might own stock in. Ford Motor Company pays a dividend, you pay tax on that. So for a small business, that thought of double taxation is often a tax deterrent. But that, again, doesn't necessarily mean that a C corporation is bad. If you have one owner of a business, that maybe would not be a good flow of the profits of the entity to that one owner. But you might have a small business that has 3 or 4 unrelated owners, and that C corporation might still be a good fit for that type of a situation. And also, if the entity is a fast growing entity and they need to grow their internal equity because of the larger brackets in a C corporation for the tax brackets, it might be a low tax way to leave profits in the company and grow the internal equity of the company.
And why would you want to grow your internal equity, to retain money in the business? Well, typically that would be to reinvest by using that money to buy other assets with. So if you're a capital intensive business, you're a construction business, and you need to buy backhoes and bobcats and different items of equipment and whatnot. If you want to finance the acquisition of that equipment through your profits rather than borrowing it from the bank, if you are a C corporation and you retain those profits in your business and you've got kind of a cash balance in the business, you can then use that cash to buy assets, okay? And that may be a lower cost way of expanding your business by getting larger by acquiring more assets. If you're a service business and you're not growing with capital acquisitions and you're just providing services, and then it may be more appropriate for you to not be a C corporation, be a different one of these pass-through entities.
Probably one of the, besides the LLC, maybe one of the more common pass-through entities would be the S corporation. There's a lot of one or few owner S corporations that give you that luxury of the pass-through, but yet you're still sort of in this corporate environment. You just don't have a corporate level tax because all the profits are going to be taxed at the individual level or individual owners levels. And then the only issue, probably one of the biggest issues, in fact, I just noticed on a letter that a client who we had just filed for an S corporation status got their letter from the IRS, and they have the classic warning in the letter that they issue, and it says, you know, you can't just make the S corporation election and not take a salary or a wage if you're performing a service for that business. And so the term they use is if you are an S corporation working for the business, you still have to take reasonable compensation out of that business. And so there's all kinds of court cases in trying to determine what's reasonable compensation. For a small business, for a large business, how do you determine that?
Is that because they want self-employment tax on it?
Right, yeah. You could say, hey, I'm gonna be an S corporation, I'm not gonna take a wage at all. Whatever profits are there, I'll take them out as a tax-free dividend, it's referred to, because you gotta pay tax on the profits. Well, they would come in and say, look, if you're working for the business, you have to pay yourself something. It's just determining what's an appropriate amount of reasonable compensation. It's based on the facts and circumstances of what you're doing and type of business, type of industry, and those kinds of things.
Who else has a question for experts? I don't want
I have a question, probably more for Keith. When I started out as a sole proprietor and filed a DBA, and then after having some discussions with folks, decided to file the LLC. Do I need to do anything do I need to withdraw the DBA or just let that expire? What's the process for that?
You could terminate it. They generally expire, I think, in 5 years. It's good for 5 years when you file it. But you could go terminate it, I believe.
But not really necessary to do that?
I don't think it would be necessary, as long as all of your materials that you provide to your customers and all of your public things that you're doing are showing that you are an LLC now, and you've got the LLC on all of your documents, and you're clearly disclosing that you're doing business as that limited liability company. But you could certainly, I think, go to the county clerk's office and ask to terminate the DBA if you want just that extra level of protection.
Okay.
Questions? I have another. Let's assume you're a small business in the service industry, and you're not, like a construction company example you gave, you're not looking to have a lot of retained earnings and so forth. But other than the obvious, what are ways that you gentlemen would recommend that a small business would look good to your bank, other than paying your loans on time and keeping out of trouble with the IRS and so forth? How, what are some financial ratios, if you will, or how would a small business keep, develop, maintain a good relationship with the bank over time?
So you indicated for more of a service type business that doesn't have a lot of need for retained earnings.
Correct.
I mean, they would still be looking at, maybe consistent revenue, which would show the ability to make payments if you had a need to borrow. Books and records being clean and up to date. They're going to want to look at tax returns. So, in terms of the balance sheet, there's not going to be a lot on the type of balance sheet of an entity that you've referred to. So they're not going to be really looking at the balance sheet, the assets and liabilities of the entity. They're probably going to base a lot of their decision on the individual and what the need for the borrowed money is, for example. So if you had an opportunity to buy some inventory at a really good deal, but you don't have the equity internally in the company, again, they would look at the need and whether or not they could, they would provide that loan, again, based on the security of the inventory, or whether they're going to want the personal guarantee or some other security interest in order to provide the loan. So they're not looking at the entity only. They're going to look downstream at who's involved, what their financial picture looks like as a personal individual as well.
Collecting from your customers is very important in that situation, okay? Bank's not going to look very favorably on a small business that has a really large accounts receivable base with a lot of old receivables that aren't paying or that are stale. That's not going to be impressive to your banker. They're going to be concerned that you aren't making good judgments about who you're giving credit to when you do business. So very important to stay on top of your accounts and make sure that you're selling to people who are able to pay you.
One of the things I was gonna suggest, like when we moved downtown, is we had to put together a whole new business plan. And that was one of the major things that the bank asked for us.
Yeah, especially if you're a new business or a young business, they want to see a good business plan that really explains, this is what my business is about, this is how we operate our business and how we can be profitable.
You had mentioned, one of you had mentioned the personal guarantee. With loans or credit, aren't those probably the rule rather than the exception these days? Don't pretty much always want a personal guarantee?
With a small business, banks are going to require personal guarantees virtually 100% of the time. After you've been in business for a really long time and have established good relationships with the banks and have a lot of equity in your business, they might, I say might, not require full personal guarantees of your loans. But early on in the process, while your business is young and while your business is small or getting established, they're typically going to make the loan in part on your personal commitment as the owner to the business. And you demonstrate your personal commitment to the business by giving the bank a personal guarantee of the loan.
I've heard bankers say, look, if you want us to believe in your business and trust in it, you know, you should be able to stand behind it as well. So
Now, doing that wouldn't be sufficient to pierce a corporate veil if you're an entity, would it?
No.
Is there an exception there?
No, yeah. Personal guarantee in and of itself is not going to be evidence of an appropriate situation to pierce the veil.
Other questions?
Have you changed the entity status from a C Corp to a pass-through LLC and S Corp, and what are the challenges that you're going to face?
You can. I think Mike can probably
Yeah.
speak to, you know, there are going to be limited times when you can do that, and there may be a cost in the year that you make the change.
yeah, you can switch between a C corporation and an S corporation. There's actually time limits because they don't want you flip-flopping back and forth every year. Once you switch from an S to a C, you have to wait, I think, 5 years before you can switch back to an S again. So that can be done without any immediate tax costs, because there would be a division of time that typically you might do it on a calendar year. Normally S corporations, the vast majority would be on a calendar year reporting. A C corporation could typically choose some kind of another fiscal year, but let's just say that both entities, C and an S, want to be on a calendar year. You might conclude the year as a C corporation, take care of any tax liability, and then you start the next year as an S corporation. And there's time limits on when to make the election. You have 75 days into the new year that you can file the election to be effective as of the first of that year. So C to S and S to C can be done. Converting from either an existing C or an S corporation to an LLC, basically you're terminating that one of those two entities and creating a brand new entity. And that could be that could cause a taxable event. So it would be like liquidating a company and then starting a new company. So those are much more difficult for a business that just wants to continue on in its current structure, to switch from an LLC or a partnership to a corporation or vice versa. So those are a little more difficult.
Any other questions this morning? I want to thank you gentlemen again.
All I can say is, wow, that was one of the most informative seminars or workshops that I have sat in on in literally decades. And with the full disclosure, I have heard of the Four Seasons. To Keith Birchler, just as a reminder, who's an attorney with Birchler, Fitzhugh, Purtell, and Sarow, thank you so much. What a great job you did for us today. And our CPA, Mike Hanisko, with Weinlander, Fitzhugh. Michael, thank you for the fantastic job that you did. I also want to thank the entire Small Business Council of your Bay Area Chamber of Commerce, particularly Dr. Lee Newton from Newton Eye Care Center, who is the chairman of our group there, for putting this program together and numerous other programs to better serve the needs of small business within the Bay Area. I want to mention a couple of programs that you might be interested in participating in that are coming up. First of all, I know that probably everybody in this room is going to have to deal with something called Obamacare. Your Bay Area Chamber on June 18th is going to be putting together a program from 10 to 10:30 a.m. over at the Doubletree on health care reform, actually showing the business people throughout the Bay Area how to navigate the new health care reform laws that are coming into place now. Most of us know very little about them, but it's something we're all going to have to deal with. Through the Small Business Council, we also have coming up on September 19th a program on marketing and social networking, and on November 12th on taxes for small business. So again, programs that we're confident that you're going to be interested in participating in. I want to also thank our friends from Bay 3 TV for being here today and televising this for us and for the people of the entire Bay Area. And when I say our friends at Bay 3 TV, I mean the friends of the entire community in the Bay Area. And thank you so much for that. One last thing. We have before you a questionnaire that we'd like each of you, before you leave, to fill out regarding today's program. So if you could fill this out, get this to Jody as you leave today, we would appreciate it. With that, again, to our speakers and to each of our participants here today, thank you for being here. It is an honor on behalf of your Bay Area Chamber of Commerce to present these high-quality programs. Thank you very much.